Hello, today we are going to talk about the advantages of adding a safe harbor provision to a 401k and the timeline to do so. To start off, what exactly is a safe harbor plan? A safe harbor plan allows owners and other highly compensated employees to personally contribute up to the IRS limits without worrying about what the non-highly compensated employees personally contribute to the plan. This is because the plan automatically passes the annual non-discrimination testing that a non-safe harbor plan is required to pass. In the case of a non-safe harbor plan, the amount the owners and highly compensated employees contribute is directly tied to the amount that the rank and file employees contribute to. This is not the case with the safe harbor plan because the company is making contributions on behalf of the employees as either a safe harbor match or a safe harbor non-elective. The safe harbor match contribution is typically one of two formulas. The first is the basic match, which is a dollar for dollar match on the first 3% an employee personally contributes, and then 50% on the next 2% an employee defers. In this way, the matching rate is capped at 4% because an employee must contribute at least 5% of their compensation to receive 4% from their company. The second formula is the enhanced formula. This is simply a dollar for dollar match, an employee deferral up to 4%. So if an employee defers at least 4% of their pay, they will also receive 4% of their pay from the company. Employers like safe harbor matching contributions because the employee must personally contribute to the plan to receive the employer contribution. However, there are limitations to adding a safe harbor matching contribution to an existing plan. There's a 30-day notice requirement, so this can only be added to an existing plan at the start of each plan year. For example, a plan with a 12/31 plan year in could add the provision to the next plan year as long as the notice is provided by December 1st. The other safe harbor formula is the safe harbor non-elective formula. This is a contribution of at least 3% that the company gives to each eligible employee. It is not tied to what the employee defers like a match. All eligible employees receive the contribution regardless of how much they are personally putting into the plan. One of the largest benefits of a safe harbor non-elective plan is that it can now be added during the plan year. There are two opportunities to add a safe harbor non-elective contribution to the current plan year and still receive the waiver of the non-discrimination testing we discussed on the first slide. The first is a 30-day prior to the close of the plan year. A plan with a 12/31 plan year end could add a 3% safe harbor non-elective contribution to the current plan year as long as the document was amended by December 1st. The second opportunity is after the close of the plan year, but the contributions must be 4% rather than 3%. This is a great option if the plan does not pass the non-discrimination testing I've previously mentioned. If you'd like to learn more about safe harbor plans, please contact your dedicated compliance consultant. You can also reach us at the phone number and email address listed below. Thank you.